There is a number haunting the global economy. It appears on the debt clocks in Washington. It appears in the trading ledgers of the London gold market. It appears in the balance sheets of the world's largest corporations. That number is 35 trillion. To most people, a trillion is just a word. It is an abstraction, a number so large it loses all meaning. But to the financial historian, 35 trillion is not just a number. It is a signal. It is the sound of a structural beam snapping under the weight of an empire. The United States government has officially breached $35 trillion in gross federal debt. At the same time, the global stock of corporate bond debt has hit $35 trillion, and in a terrifying coincidence, the annual trading volume of the London gold market, the only real money left, has also reached 35 trillion. This convergence is not an accident. It is an inflection point. It marks the moment where the value of paper promises exceeds the productive capacity of the civilization that issued them. We have been here before. A century ago, the British Empire, the greatest power the world had ever known, the master of the seas and the banker to the globe, made a series of financial mistakes. They prioritized immediate political comfort over long-term investment. They used accounting tricks to hide their liabilities. They believed that because they owned the world's reserve currency, they could borrow forever. They were wrong. In 1976, the United Kingdom, the former ruler of the world, was forced to go hat in hand to the International Monetary Fund and beg for a bailout. It was a sovereign humiliation that marked the final end of British financial dominance. Today, the United States is walking the exact same path, but on a scale that is terrifyingly larger. America is repeating the British mistake, but with higher stakes and faster algorithms. Welcome to the Financial Coin Historian. Today we are going to conduct a forensic investigation into the $35 trillion mistake. We will uncover the sinking fund fallacy that fooled the British and is fooling Washington today. We will explain why the Triffin dilemma guarantees the death of the dollar, and we will show you why the bond market, the true master of the world, is preparing to revolt. The history books are open, the ledger is bleeding, and the collapse has already begun. To understand the future of America, we must look at the past of Britain. The parallels are not just similar, they are mathematically identical. In 1815, after the Napoleonic Wars, Britain emerged as the victor. But it was a victor drowning in debt. The British debt-to-GDP ratio exceeded 200%. They had borrowed massive sums to defeat France. But here is the difference between the Britain of 1815 and the America of today. 19th century Britain had discipline. They maintained a political consensus for fiscal austerity that lasted nearly a century. This allowed them to consolidate their debt and finance the Victorian expansion. They used their debt to build railroads, factories, and global infrastructure. The sinking fund fallacy. But even then, the seeds of the mistake were planted. In the late 18th century, British politicians came up with a clever idea called the sinking fund. The theory was simple. The government would set aside money to buy back its own bonds. They believed that the compound interest earned on this fund would eventually wipe out the national debt. It sounded like genius. It was actually a delusion. Why? Because the money paid into the sinking fund came from the government budget. When the government ran a deficit, it had to borrow money just to make the payments into the fund. Effectively, the state was borrowing from Peter to pay Paul, while both Peter and Paul were the state itself. It was an accounting trick, an illusion of responsibility designed to hide the reality of insolvency. Does this sound familiar? Today, the United States runs a Social Security trust fund. We are told it is a lockbox. In reality, the government borrows from this fund to pay for current spending, leaving behind IOUs. It is the sinking fund fallacy reborn. It is the belief that you can solve a debt problem by moving money from one pocket to another. The shift to consumption. The British Empire didn't collapse because of the sinking fund alone. It collapsed because of a fundamental shift in spending. Starting in the 1920s and accelerating after World War II, Britain stopped investing in production and started spending on consumption. Resources were redirected from the military, infrastructure, and industry toward the welfare state, public housing, pensions, and healthcare. Now, these are noble goals, but economically, they triggered a crowd-out mechanism. By consuming a larger share of national income, the government left fewer resources for the private sector to invest. Productivity collapsed, innovation stalled, and the British pound, once the good-as-gold standard of the world, began to rot. The British mistake culminated in one specific year, 1976. This is a year that every American policymaker should study in terror. By the autumn of 1976, the UK faced a triple crisis. Inflation had hit 25% the previous year. The fiscal deficit was 9% of GDP, and the sterling was in free fall, plunging from 230 to under 160s. The world had lost faith in Britain. Investors stopped buying British bonds, gilts. The government was running out of cash. The Prime Minister, James Callaghan, had to do the unthinkable. He had to ask the IMF for an emergency loan. Imagine that. The nation that once ruled an empire on which the sun never set was now begging for a loan like a developing nation. The IMF agreed, but on brutal terms. They demanded massive spending cuts and strict monetary controls. The lesson of 1976 is clear. Market discipline applies to everyone. Being an empire does not protect you from math. Being a reserve currency holder does not protect you from a buyer's strike. When the bond market decides you are insolvent, your history doesn't matter. Your nuclear weapons don't matter. The only thing that matters is your balance sheet, and Britain's balance sheet was broken. Now, let us turn our eyes to the United States. If Britain was the warning, America is the amplification. The United States is repeating the British error, but on a scale commensurate with its $28 trillion economy, the velocity of debt. The gross federal debt has breached $35 trillion, but the absolute number is less terrifying than the velocity. The U.S. government is now adding approximately $1 trillion to the national debt every 100 days. Let that sink in. Every 3 months, America adds a burden equivalent to the entire economy of a mid-sized nation. The tax cut paradox. How did we get here? Just like the British sinking fund, America has engaged in its own form of fiscal delusion. A primary driver has been a series of tax cuts, the Bush tax cuts, the Trump tax cuts, that were never matched by spending reductions. Research shows that these tax cuts are responsible for 57% of the increase in the debt ratio since 2001. The logic was supply-side economics. The idea that tax cuts would pay for themselves through growth. This is the modern sinking fund. It is the belief that you can subtract revenue and magically increase wealth. It is a lie. The primary deficit. The United States is currently running what economists call a primary deficit. This means that even if you ignore the interest payments on the debt, the government is still spending more than it earns. This is the definition of a debt spiral. And now, the interest rates have risen. The era of free money is over. Net interest outlays on the federal debt have exceeded the budget for national defense. America now spends more on servicing its past mistakes than it does on defending its future. You might ask, if the U.S. prints the dollar, why does debt matter? Can't we just print more? This is the argument of modern monetary theory, MMT. It says debt is not a constraint for a currency issuer, but history has a rebuttal. It is called the Liz Truss moment. In September 2022, the British Prime Minister Liz Truss announced a plan to cut taxes and increase borrowing. She ignored the reality of inflation. The bond market rebelled. In 1 week, the yield on 30-year British gilts rose by 140 basis points. The pound crashed. Pension funds nearly collapsed. The market did not care that Britain issued its own currency. The market said no. Liz Truss was forced to resign after 44 days. This proves that monetary sovereignty has limits. If you abuse the privilege of printing money, the bond vigilantes, the global investors who buy your debt, will destroy you. The United States is flirting with its own Liz Truss moment. With inflation sticky at 3 to 4% and deficits running at 7% of GDP, the U.S. bond market is becoming increasingly volatile. If foreign buyers, Japan, China, Saudi Arabia, decide to go on strike, U.S. interest rates will skyrocket. The cost of that $35 trillion debt will become unpayable overnight. The rot is not just in the government. The $35 trillion figure appears again in the private sector. The global stock of corporate bond debt has also reached $35 trillion. During the years of zero interest rates, corporations gorged on cheap debt. They didn't use it to build factories or improve productivity. They used it for stock buybacks, dividends, and mergers. They created what economist John Kenneth Galbraith called the bezel, fictional wealth. Asset prices rose, but productive capacity did not. Now, rates are higher. Companies that borrowed at 2% must refinance at 6% or 7%. This creates a maturity wall. As these corporate bonds come due, many companies will face a choice: restructure or bankruptcy. This is the systemic risk. If the government tries to bail out the corporate sector, it adds to the sovereign debt, worsening the inflation. If it doesn't, the economy collapses. We are trapped in a feedback loop between public and private debt. At the heart of this crisis lies a paradox named after economist Robert Triffin. The Triffin dilemma states that the country which issues the global reserve currency faces a conflict of interest. To provide the world with enough money for trade, it must run trade deficits. It must export dollars. But running chronic deficits eventually destroys confidence in the currency. For 80 years, the U.S. has enjoyed the exorbitant privilege of the dollar. We could print money to buy oil, electronics, and cars. The world accepted our paper. But the Triffin dilemma is now entering its terminal phase. The U.S. debt is so high that global actors are questioning the value of the dollar. The fiscal capacity of the American state is exhausted. The rise of gold. This brings us to the third $35 trillion figure. The annual trading volume of the London gold market, the hub of physical gold, has reached $35 trillion. Why does this matter? Because gold is the anti-dollar. Central banks in China, India, Poland, and Singapore are buying gold at record rates. They are de-risking. They are moving away from U.S. treasuries. They know that $35 trillion in debt cannot be paid back in real terms. It can only be defaulted on or inflated away. Gold is their insurance policy against the inevitable American default. The final symptom of this decline is the end of American benevolence. The U.S.-led order was built on open markets. We allowed the world to export to us. But now, crushed by debt and deindustrialization, the U.S. is turning inward. Tariffs, sanctions, trade wars. The government is desperately trying to plug the gap with revenue from tariffs. But tariffs are just a tax on consumers. They increase inflation. They slow growth. The shift toward protectionism signals to the world that the U.S. is no longer the guarantor of the global system. It is just another indebted nation fighting for survival. The $35 trillion inflection point is here. It is not a prediction. It is a current reality. Britain ignored the warning signs in the 19th century. They relied on accounting tricks like the sinking fund. They prioritized consumption over production. And they ended up broken, begging the IMF for a lifeline. America has followed the blueprint perfectly. We have the accounting tricks. We have the consumption. We have the debt. The only question remaining is, when will the bond market finally say no? The convergence of $35 trillion in sovereign debt, corporate debt, and gold trading tells us that the system is primed for a reset. The Liz Truss moment proved that even G7 nations can crash in days. The United States is larger, yes, but gravity applies to elephants just as it applies to mice. We are witnessing the slow-motion collision of the past, debt, with the future, reality. The dollar's dominance is not a law of nature, it is a privilege built on trust. And $35 trillion of debt is a lot of trust to ask for.